India's stock market is on fire. Everyone wants a piece. But is it too late to join the party? Are stocks overpriced? That's what we're diving into today. Buckle up. It's time to talk valuations. We're going to break down what makes a market pricey or a bargain. Think of it like buying a used car. You check its history, its mileage, its current condition. Same deal with the stock market, except we're talking about companies instead of clunkers. Historical valuation metrics are like a used car's mileage. They tell us how expensive the market has been in the past. One key metric is the price-to-earnings ratio, or PE. It compares a company's stock price to its earnings. A high PE can mean investors are really optimistic about the future. A low PE might signal pessimism or a good buying opportunity. We look at these ratios over time to see if the market is unusually high or low. Another important metric is the price-to-book ratio, or PB. This compares a company's market value to its book value, which is basically its assets minus its liabilities. A high PB can indicate overvaluation, while a low PB might suggest undervaluation. Now, let's pop the hood and look at India's current valuation metrics. Are they flashing any warning lights? The Indian market's PE ratio has been trending upwards in recent years. It's currently above its historical average. This could mean that investors are expecting strong earnings growth in the future, or it could be a sign that the market is getting ahead of itself. The PB ratio also paints a similar picture. It's higher than its historical average, suggesting potential overvaluation. But wait, there's more. We also need to consider macroeconomic factors like interest rates, inflation, and corporate earnings growth. These factors can influence investor sentiment and affect valuations. Section 4 Real Talk. Companies and their worth. Let's get down to brass tacks. Valuation metrics are just one piece of the puzzle. We also need to look at individual companies and their fundamentals. Are they profitable? Are they growing their earnings? Do they have strong balance sheets? Take a company like Reliance Industries, for example. It's a conglomerate with businesses in oil and gas, telecom, and retail. It's been growing rapidly and generating strong profits. Its valuations might be justified by its growth prospects. On the other hand, some companies might be riding the wave of market exuberance without strong fundamentals. These companies could be vulnerable if the market sentiment turns sour. Section 5. So, you want to be a rupee millionaire? So, is India's stock market overvalued? The answer, my friends, is not so simple. Valuation metrics suggest that the market might be a bit pricey, but strong economic growth and corporate earnings could justify these valuations. Investing in India requires careful consideration. Don't just blindly follow the herd. Do your homework. Research individual companies. Look at their financials. Understand their business models. Consider your investment goals and risk tolerance. If you're in it for the long haul, you might be able to stomach some volatility. But if you're looking for short-term gains, be prepared for a bumpy ride. Remember, investing always involves risk. Don't invest more than you can afford to lose.